We're now opening the floor for Q&A. If you have a question, please raise your hand and we'll bring a mic your way.
Okay, all right. Thank you so much for spending the time with us. I hope that was insightful. We're ready and open to answer any kind of questions. First thing I want to do is just quickly run through the faces that weren't on stage today, an integral part of our team. And we'll start with you, Mark. Can you just tell them who you are?
Yeah, thanks, Kate. I'm Mark Hacker. I've been with Lumen about 10 months now, and I'm the Chief Legal Officer. I'm responsible for the legal team as well as the public policy team and also the public sector segment.
Hi everyone, my name is Kai Prigg. I've been with Lumen for 2.5 years. Interestingly, my first day at Lumen was the last investor day here in,
That's right.
in New York. And I can tell you it is a completely different company compared to the company that I joined a couple of years ago. I'm the Chief Commercial Operations Officer. I look after the planning, the design, the deployment, manage professional service operations of the network, and as of a couple of weeks ago, also have the accountability for the remaining mass markets business.
Hi everyone, I'm Anna White. I'm the Chief People Officer, and I've, similar to Kai, been here for 2.5 years, joined a few months after you, and I head up HR and really drive the people and culture agenda to increase employee engagement and also work to drive business performance.
3 extremely humble people. I think of Mark as the guy who helps us safely get to yes in transforming a telecom into a digital company. I think of Kai as the person that took us from negative net promoter score to positive across literally every single segment and did it on time and on budget. Thanks, buddy.
Okay.
And I think about Anna as the culture ninja, literally inculcating everything about our culture into all of our processes. It's why we're here. So thanks to the 3 of you. There's a new kid in town.
I appreciate you calling me a kid, by the way.
You got it. You got it. Anything, by the way, return the favor. So Jeff Sherritt's joined us 2 weeks ago, 3 weeks ago?
2 weeks, 2 weeks.
Have you sold anything yet?
Yes, we're working on
All
it.
right.
Yes,
So why don't
absolutely.
you tell them about yourself?
Good morning. I'm Jeff Sherritt. I'm the Chief Revenue Officer, and I joined the company, like Kate said, about 2 weeks ago. I spent 24 years at Cisco Systems prior to coming to Lumen.
Awesome. Think connected ecosystem and think Cisco sales model, and you might be onto what we're trying to accomplish here. So we're super excited about that. You're the moderator. Did I tell you that?
Yeah, I get to moderate.
Yeah, you go.
So we've got mic runners. Please wait for the mic to get there to ask a question because we've got hundreds of people that are streaming in today for this, and we want to make sure they can hear your question. Also, please say your name and the company that you're with. But with that, why don't we get started?
Giddy up.
Batya Levy from UBS. Thanks for all the information that you provided. Maybe stepping back, what we're really focused on this transition of digital revenues ramping and legacy base coming down. So can you set the stage in terms of where we are right now in terms of that MRR 990 of digital? Where is the legacy piece? And where is the sort of the new digital customers? Are they all new? Are they accelerating the legacy declines to take on these digital services? And you have made assumptions that maybe legacy declines similar to market rate, but because you're accelerating the digital effort, does that accelerate the legacy decline? So that path would be helpful. And maybe just sort of, what do you see as the biggest risk to this 5-year outlook? Thank you.
I'll take the customer patterns. You take the rest of. You take
Yep.
the hard stuff.
Sure.
Okay, great.
Yeah.
So if we think about who's buying NAS and why, we really, again, kind of started this as a test. It was a little bit of a hobby. And what we saw were customers that were requiring a network upgrade, and they wanted to modernize and do so quickly, were the ones that came. Lots of mid-sized companies, and frankly, the platform was tailor-made for them. As we started taking our story to large enterprise, there were a few things that we needed to do in order to, cover their requirements, which I think we've gotten locked and loaded, and we've got some really exciting large enterprise multi-site opportunities in the pipe right now. And it's a mix. These are companies that are in existence today, and they've recognized that their networks aren't big enough, fast enough, smart enough, or secure enough. And so they're making the transition. Sometimes we're doing a migration project and there's services involved. Sometimes it's the beginning of the life cycle and it's just a test. And once that test happens, we usually get to yes pretty quickly after there. I think we're going to have a hybrid environment, Batya, for a really long time. And I will just say one word: cloud. We've seen this movie before. Remember when we thought everything was going to cloud? And then, first, nothing was going to cloud. I'm not putting my data in that thing. Then, when CIOs got their head around moving data into the cloud, it was kind of like, okay, now everything's going to go. And that's just not the case. It's what's the most cost-efficient way for me to drive storage and compute? And now, how can I have a programmable network that helps me achieve that cost efficiency curve? And that's going to be hybrid. There's still going to be on-prem. There's still going to be edge. There's going to be lots of multi-cloud and data center. And it's the opportunity for our company. We move data for a living, and it needs to be moved from anywhere to anywhere all the time. So you want to translate that
Sure.
into numbers? Good luck.
Yeah, so first of all, in the model, the assumption on that 600 million is the incremental piece. Now, with that, there isn't one of us on stage, if granted one wish, who wouldn't wish for complete cannibalization of our legacy business. Because what we're seeing in the customers that consume digitally is a much lower rate of churn, a much higher rate of service adoption, and a much faster time to revenue at higher margins. So the reality is, this is an industry, again, let's go back to that phrase, playing not to lose. Oh, protect the legacy, versus playing to win. Playing to win is, I want to take all that share to myself. And if we can get customers on that platform, then we would expect the 600 million to be higher, so first of all. And second of all, we think that that's got much better lasting economics for our shareholders.
I think there's one more point to add, and Jim, I might ask for your help here. What we described today in the tech platform, the intelligence sits in Lumen Connect, right? Lumen Connect, the single pane of glass, the control panel for a programmable network, is what makes a fabric port a fabric port. And what we're testing, and we don't have this baked into our numbers, is our ability to go into our install base and remotely see legacy ports and convert them to become fabric ports. Now, that wouldn't change the state of the customer. It would simply enable us to make that customer port into a port that could carry multiple services, wouldn't require a truck roll, and would become a point of growth. It's limited by several factors, including what's the bandwidth of that port, where is it, a bunch of different things that we're trying to figure out right now, but it's a potential accelerator. Anything to add to that?
No, you got it. So kind of picture, if you will, we have a customer today that uses us for direct internet access. Our vision is they go into Lumen Connect, they flip a switch, and all of a sudden it is now a fabric port, and they have the ability to add additional services like multi-cloud gateway, which then gets them kind of one place across all their Meet Me rooms to be able to route traffic east-west across their cloud providers. That's how we see what we have as our install base turning into a growth engine.
Yeah.
Oh, go in here. Yep.
Hi, Bill Matthews from Global Credit Advisors. If you think about the kind of EBITDA margin expansion from 27 to the mid-30s and that $600 million revenue piece of it, can you just help us kind of understand how much that margin expansion is driven from these new revenue additions versus kind of cost saves, and maybe tying that to, if you think about this NAS network up and down dynamic positioning where customers can dial up and back, how is that pricing versus existing long-term contracts they have in place?
So the margin expansion, I would say, is coming from four areas, right? The digital expansion, PCF onboarding, and our modernization and simplification programs are all margin accretive. But as EBITDA starts to grow, we're also going to get operating leverage benefits because our fixed cost structure isn't going to change materially. And so all of those initiatives are feeding that. We're not splitting that out. And I think you probably understand that. I don't want to hand that to our competitors. But they're all high margin services and they all benefit us over the long run. Do you want to talk about the pricing?
I'll let our Chief Marketing Officer and Strategy Head talk about it.
Yeah, one of the things that we're doing is we are going across all of our products. We're looking at margin. The first thing we have to do is we have to get our customers loving our customer experience. So everything is rooted first in that customer experience. We're bringing those services to them. We're also making sure that they have value accretive services added to that. And then we're able to go and deliver the experience thereafter and match the pricing where they're able to go in and have those bundles and one view that a CIO can look at end to end to look at a real value accretive solution together from a trusted partner where we're bringing it all together for them.
That's right. And it's no secret, I came from the world of cloud from Microsoft. I learned a ton there. And wherever I can plagiarize from the playbook of the movie that we all saw in cloud, we're going to do so. And I think an extremely efficient pricing model that we are applying to our network as a service platform is the service price is the service price. You make a bigger commitment to us, we're going to make a bigger commitment to you in terms of driving price efficiency. And I think that's new to telecom. It provides a little bit of resiliency in terms of the go-to-market offerings and the pricings and the way that we do it, and it drives loyalty and commitment and work like a charm in the days of cloud. So we'll be copy-pasting that one.
Hi, Bill Cavalier, Odeon Capital. I may be a little confused, so can you walk me through two things? They're both on the legacy side. What's going on in the legacy copper business that, last time you discussed it, it was worth like $6 billion as a, NAV. And then is the $600 million that you're talking about incremental to, is the way you're converting your legacy business revenues that are declining? And is that the business that you're talking about? Because I think we're all confused about where does this $600 million come in and how does that fit in with the kind of growing orange bar?
Yeah, so on the $600 million, Kate talked about over 2,000 customers. Many of those customers are new. Some of them are existing. What we're seeing is that as customers engage in a digital motion, they're buying more, they're buying it more quickly, it's getting deployed more quickly, it's at higher margin, and they churn less. So that's really the path forward for growth across the entirety of our platform. As it relates to legacy, our legacy business, when we talk about it, it's largely copper-based and it's going away, right? Those are the businesses that are naturally declining. That's what we forecasted in the model. They're cash rich and there's a tremendous opportunity inside of that. There's an opportunity around how we expand the amount of cash that we can extract from that business. And there's also an opportunity to say, hey, customer, there's this new thing over here. Now, how we go about that, the timing in which we'll engage with a customer on that is going to depend. But Kai's really leading our efforts on how we manage the legacy business from a copper standpoint. And maybe you could
of course.
provide some color.
So the copper network, or we call it the ILEC network, supports a large enterprise base as well as a consumer base. So what we've been spending our time on is really mapping out the entire base, understanding each and every one of our wire centers, and of course there's hundreds of wire centers across the country. We've been able to map the P&L for every single one of those wire centers. And so we know the direction of travel. When one of those wire centers becomes unprofitable, that will be a trigger point for us to then work with our customers to move them to go-forward products, right? So go-forward products for consumer, go-forward products for enterprise. We will then be able to shut down those wire centers methodically over the next few years as each and every one of those approaches that. In the meantime, though, we have to care for those customers. And so there's a lot of work, obviously, that goes into maintaining the network, making sure that when the customers have outages, that we're able to respond to those customers and look after those customers to the best of our abilities. So you'll see us working on the operations, on the maintenance, keeping the systems up and running, serving the customers that rely on those systems day in, day out. But then you'll see us taking action where we need to take action, where we see the P&L of a particular area of the network is heading in that direction where it's cash flow negative, and then we'll be taking different actions with the customers and with the network in those areas.
Thanks. Frank Loudon with Raymond James. So two questions. When we look out to your longer term guidance of sort of mid 30% EBITDA margins, if we back out the MAR from the revenue and the EBITDA, what would that margin look like under that kind of scenario? And then for Jeff, just curious your vision for the organization and how long do you think it's going to take to sort of implement that to see the benefits from the changes you're going to make? Thanks.
Yeah, on the first one, we're not going to break it out that way. I would just go back to the answer that I gave earlier. If you think about the key initiatives, right? Growth in the digital and the ecosystem, growth in PCF, modernization and simplification, and operating leverage, that's all those things individually contribute to the margin expansion that we're seeing. And again, let's not forget, and this is where I think a lot of people get wrapped around the axle, is they're like, but the legacy business is super high margin. Yeah, so is this stuff, okay? We're gonna be okay. And so it's about when is the right time, as Kai said, to convert a customer from old to new, and we're gonna be very methodical about that. And then, yeah.
Okay. Yeah, I mean, I think from a go-to-market perspective, I mean, Kate talked about the transition in the cloud business, you know, software going from on-prem or perpetual-based licensing into subscription-based licensing. You know, I was at Cisco, we did roughly 20% of our business was subscription. We moved that to north of 50%. So we've kind of seen this motion and the transformation that's required in a go-to-market model to be able to deliver. The good news is I think there's some good foundational pieces in place. If you think about the work that's being done in the connected ecosystem, we have some good work and pilots going on around customer success in the new motion. But there is some work to do on, you know, how do we upskill our sellers as it relates to moving up the stack, delivering more value to clients, calling on a different buying center that's a little higher in the stack than what they're used to traditionally. Think about scaling the customer success motion, scaling the connected ecosystem, and then there's a significant opportunity to scale through general partners in the marketplace as well. So if you think about VARs, resellers, SIs, et cetera, we think there's an opportunity to drive growth through an extended channel as well. So there's work to do, but I think there's a good foundation in place to build upon.
We got one back here.
Jeff Harleb with Barclays. Chris, two things. First, on the revenue outlook slide, when you said legacy decline in line with market, grow in line with the market, can you quantify that a little bit? And then the comment on opportunistic deleveraging. Anything else you can say about that? Is that going to be through the free cash flow you expect in 26? I know you've pushed out a lot of your maturities, you know, to 28, 29, et cetera.
Yeah. So on the deleveraging piece, we will be opportunistic, and it's really going to depend on what happens with things like our borrowing rates, right? That'll be a market condition. It'll also be based off of what happens with upgrades. And so if we see an opportunity where it makes economic sense to retire something earlier, then we'll do that. But again, the model assumes for now nothing opportunistic. It simply assumes that everything is paid on maturity, you know, when it comes due. And sorry, the first part of the question slipped my mind.
The other one was on the revenue outlook, grow versus legacy. Can you quantify that?
Oh yeah. So in terms of what defines the market rates of growth and decline for strategic and legacy, that's really what you would see published by industry analysts. So the Gartners, the Forresters of the world, it's really those numbers.
Hey, Nick Dalday with MoffettNathanson. Thanks for hosting the event. Two questions. First on NAS, you know, the slide with all the different logos, a lot of diversity there. So I was wondering if you could talk about some of the commonalities, you know, between those customers and why they came to you for the service and the education process required to get them to sign up. And then from an M&A perspective, a few months ago at your industry analyst event, Kate, I think you talked about potentially acquiring service capabilities. And I was wondering if you could expand a bit on that and whether that's still something that's of interest. Thanks.
So we are looking actively for any capabilities that are available in the marketplace that will help us accelerate our path to growth, period. And we have a very crystal clear vision about what a programmable network looks like, what Lumen Connect and the single pane of glass looks like, and the kinds of things that would help us leapfrog. We're not looking for continued linearity, you know, that's expensive. That's not interesting. It's, if we see a leapfrog, you're going to see us move to grab it. And when I say service, I want to make sure we're not talking about professional services. We're talking about digital services that we would be able to put on ports and grow that NAS business through the J-curve, okay? NAS customers and themes. It's interesting because I took you through an engineering design firm with 60 sites. You think financial services, retail, hospitals, they're all multi-site. They all have a need to move data in between these buildings, but it's not just about networking buildings anymore. It's about networking workloads and agents and, you know, and applications. And they all are seeing that fundamental need with this urgency around being on the most efficient point of the cost curve. Like CIO, deliver insight at the speed of thought in a sea of complexity, you know, at a cost point that probably is less money than you were allowed to spend last year. And NAS helps us do that in a number of different ways because operationally, it's easier to manage. Once you get that first fabric port in there, you can grow and expand without the traditional marginal costs associated with that. There's an efficiency of cloud-based solutions. You're counting on Lumen to do the innovation for you. So you get that, you know, by default, and we continue to give you more and more. So it's going to put a little bit of wind in your sails. These are the kinds of things that the companies that first took a step into this thought about. And it's still pretty early, but I think what you'll see is, you know, with Lumen validated designs and with our technology partners, as technology companies mature, they start to really align by industry so that they can speak the language, really have mastery over the business outcomes. And for the first time ever for this company, and probably in networking, link the value of the network to the business outcomes that our customers are trying to drive. That will be the next couple of steps that we take, and we'll do so as and when we can. I think Jeff and Ryan, who's jumping to add to this, would obviously share.
Yeah, the one thing I would add here is I talked about quick, secure, and effortless during the presentation. But when you talk to some of our customers, they are saying that what we've actually promised, we are delivering. And that is not something that always happens. They're surprised at the customer experience. You heard, as Kai talked, changing our NPS scores and some of the metrics that our customer satisfaction plays a key role into. Some of the things that we're delivering with rapid routes, where you're actually turning up some of these routes much, much faster than ever before, and then you're turning the bandwidth up and down as you need it. That is not something that these customers have had before. And so we see this across industries, and we are committed to what we're presenting here, actually delivering and exceeding that. And that's what we've been doing, which is why you see the growth of that the customer count going up significantly in that manner.
It's a cluster in here, yeah.
I'll start. Hey guys, thanks for the day. Dave Barton from New Street Research. Kate, I really liked your presentation because you did something I've never seen before, which is try to create a P times V construct around this industry, something that I know Chris has been working on for a long time. So what I saw was customers, ports, active ports, services per port, and MRR per port. And if you could kind of continue to disclose that, I think that would strengthen people's conviction in getting to that $600 million number. Mm-hmm. Are you guys going to do that?
Don't answer that question. Go ahead.
She was waiting for you to ask a question.
Yeah.
Yes, and so it's certainly to begin with, it's number of customers, ports, services. The MRR piece, in time, I don't know that we'll do that right away, But yes, we will continue to share adoption metrics so that you guys can see the pacing of what we're doing. I think what's really encouraging and gives us conviction is that if you just look back over the last few quarters, those rates of growth have been in the high 20s to 30s, quarter on quarter. And so it's important that we continue to do that, and we will.
For you, how does that long-term outlook slide change if, an old person like me wants to back out the non-cash IRU revenue, which seems to be a big part of the pivot in revenue growth and EBITDA margin, but isn't really about what's happening in the business today. It's about what happened last year and 2 years ago.
No, it's a good question. And what we have said publicly about that is that if you get the model right, what you're going to see is that the PCF business generates a lot of free cash flow. And then everything else is effectively break even. Now, that's a bit, we're burdening that a little bit too much because we're assuming all the tax liability of PCF actually sits in the base. So we've got to do a little more work on that. But the reality is that the non-PCF business is fully funding itself, including all the things that I talked about, like pension and debt retirement and whatnot. We're not allocating any of that to PCF in our thinking. So we like where that lands right now because we're in growth mode. We're investing every extra dollar that we have from that business back into that business. So I think that's what you'd find if you split it up.
Thanks, Mike Rollins from Citi. Thanks for hosting us and congrats on the progress. So I have 3 questions if I could. The first is on the TAM, the second on strategy, and third a financial question. So on the TAM, you've gotten to 2,000 NAS customers in a very short period of time. Can you help frame that relative to the number of customers that your company has captured over the past 25 years? And also, how many customers are out there that you could go after that you currently don't have? So just trying to size that TAM. The second is how much...
Do we want to... We'll let you go. We'll let you keep going. Well, this is hot. Let's
answer that, and then we'll come back to the other two.
Yeah, when you look at the TAM that we talked about for both north, south, and east, west, and you look at our customer base, and you look at the numbers that we showed you from Chris's presentation, it's a small single-digit percentage of the total capacity that we can go after. So we've taken a very conservative view in how we've built out the financials and how we think about what the market is. But it is a small single-digit percentage of what we think the total market share is. The thing I didn't cover as much on mine, we have access to both on-net and off-net for these services. So when we talk about NAS, it's not just an on-net capability for us. We can do these same services for both on-net and off-net customers, which increases the population we can go at even greater than what our existing install base is.
And as I described earlier, I think that install base, Mike, is going to become an asset in the acceleration of our digital business as we figure out the ability to turn or convert legacy ports, the ones that qualify to fabric ports.
Great. And then secondly, how much of your opportunity do you expect to go through network neutral data centers, which have been a meeting place for a wide range of diverse networks and ecosystems, versus how much of this can you bypass these neutral data centers, get it completely on the Lumen network or those of your customers, which could create a different experience, value proposition, et cetera?
So I think I'll start. I'll let Jim finish. What I've learned from our customers is that they really want choice. And what I've learned from the ecosystem is that they're trying to figure out where everybody's playing and what constructs are going to endure versus which ones are going to change. My prediction, and it is only that, is that taxing constructs of the Cloud 1.0 era are going to become obsolete. And I think revenues associated with that, like cross-connect fees, like egress fees, are at risk. Value with quick, secure, effortless connections to where you need to be without that taxing system. Anytime we charge something for a customer, it will be because there's innovation behind it, whether it's multi-cloud gateway, whether it's the fiber solutions that we have in our physical network, whether it's on-ramps, et cetera, et cetera. we will get fair market value for those capabilities, which oftentimes are net new. But I talked to Batya about a hybrid world. It's not like every CIO is going to shut down their network and pivot overnight. These are sticky structural issues that if you go back to the cloud movie and you rewatch it, you know that it takes some time. But after maybe 5, 6 years, you hit this acceleration moment where there's critical mass leaning into the changes because there's value there. And so it's not, our data center cross-connect model or ours. We think our customers are going to probably want both. Guess what? Those data centers, they need us to connect to those 400 gig on-ramps as well. So we get the business from both sides of the equation. The disruption is all about knowing that these models are actually going to have an impact on the old taxation system. Do you anything to add?
Yeah, I do. I got this question at the break, and I did a horrible job of answering it. And it's really around this multi-cloud gateway is where your question is really headed. And the Meet Me rooms you brought up, Meet Me rooms are really a Cloud 1.0 construct. They're a physical instantiation of a way to connect into the clouds. That's a 1.0 construct. There are thousands of them across the United States. What our multi-cloud gateway does is it takes the inter-cloud communications that go from Meet Me room to Meet Me room, and we push it up into our network. It doesn't have to come back to your facility anymore. Our ability to facilitate the cross-cloud communications through the multi-cloud gateway reduce the number of hops back or reduce the number of hops you're making on the public internet to run your business versus over the private Lumen connection framework we've built across all the cloud on-ramps. So when you think Meet Me room, that's Cloud 1.0. Cloud 2.0 is our multi-cloud gateway that pushes that up into our connection framework.
And I would just add, the compelling event for the customer is also the new type of scenarios. We gave a couple examples of the less than 5 millisecond scenarios, but as more and more of those come, that's a compelling event that requires it. There's also that financial benefit of ingress egress fees and looking at cross-connect fees that could be at risk, but the customers may be compelled to move because scenarios will look different and perform differently for their customers when we can quickly move that into a service faster with a multi-cloud gateway and others.
And I think in all of that, we're starting to see new KPIs emerge. Fastest time to first token is a new metric that we are obsessed with because we have a right to win when it comes to performance against that. I think TCO is also something which Jim hit directly in his presentation. It's like you can't have GPUs sitting idle. You can't, and so you need bigger, fatter pipes, washing those GPUs with data, and that's exactly what we bring to bear.
Very helpful. In fact, just follow up on the financial one.
He's got one more. He's being very greedy today.
Sorry.
That's right.
Just quick on the financials. Mass markets. So it looks like in the margin calculation, mass market revenue is in that revenue denominator. So it's total revenue, the margin on that. And the question is, if that's fair, what's the average rate of mass market revenue decline that is the base case for Lumen? And thanks for all the questions.
Yeah. So the revenue forecast that I showed is business segment only, okay? Because what we've said is that the business segment we think inflects in 2028, total business is 29 because of that mass markets piece. As it relates to mass markets, our best guess is again, basically continuing with market trends, which would put us kind of in the low double-digit decline rate territory. So it's going to take many years for that to go away, which then leans into what Kai said earlier. And by the way, part of the thinking with the mass markets customer there is there an alternative service that we could provide through wholesale arrangement or something like that? So there's multiple pathways. But the reality is it is cash rich, and that's how we're going to manage it. Remember, our locations where we have copper, broadly speaking, are more remote, and the customer skews older and generally doesn't like change. And the proof point in that is they didn't move to cable 20 years ago, right? They've stayed on DSL and copper voice. So part of this is just going to be customer atrophy. But again, there's a long runway there for us to harvest that cash.
There's a long runway, and we have transparency. I think what Kai has brought, to us is rigor for process, but also, transparency of data. So he talked about, when something goes cash flow negative, it used to surprise us, and now we can see it turn orange before it turns red. And the orange is the trigger point for activation for us to use all of our tools to exit that market, which is super cool.
Yep.
Great, thank you. Mike Funk from Bank of America. AWS and Google signed or formed a multi-cloud agreement in December, which makes me wonder if the PCF deals you're signing today, if you're potentially arming future competition for that east-west traffic that you talked about, and why those customers could not provide that service.
So I'll take the first part. And the one thing that we've been very clear about in that regard is that those pipes, that capacity, is for their own internal consumption for model training. It can't be resold, period. But I don't know if...
Is it?
Okay. This one here.
Hi, Sebastiano Petty, JP Morgan. Thank you for all the information today. Just a quick question on, Chris, clarification on 2026 EBITDA growth. I think in the prepared remarks on the fourth quarter call, you talked about an inflection in 2026, but not necessarily each quarter. And then today it's exiting the year. So any kind of nuance there that we're reading into?
No, there's no hidden message there. EBITDA will inflect for the year. We're not predicting the quarter that happens in, but for the full year, EBITDA will be higher in 26 than it was in 25.
Okay, thank you. And then just to follow up on cash interest expense, if you're focusing on deleveraging, EBITDA is growing. Why should we assume cash interest expense is flat over the forecast period?
That's an inherent assumption on where market rates go. So if you look at the debt that matures the soonest, it's pretty low coupon debt that was put into place years ago. And so when you replace that, you pay that down, and then there will be some replacement along the way. We would expect that we end up in relatively the same place. So you could argue there's some conservatism in that, but I think for now it's a fairly safe assumption.
Got it. And then I guess one last shot at EBITDA trajectory after 2027. But operating leverage makes sense, mix shift. But are there any other transformational kind of investments, or is that basically embedded within the operating leverage that you're kind of assuming?
It's really the only other one that we've talked about extensively is really the modernization and simplification, that $1 billion run rate exiting 27. I mean, look, we've been really candid that yes, we're going to inflect EBITDA this year. It's a huge accomplishment. It's not a huge inflection, right? Because we're navigating kind of that trough where we move from a downward trend to an upward trend. From here forward, the growth rate gets more meaningful as those other things start to come online. Question back here? No? Over here.
Hi, thanks. Jiten Joshi from BNP Paribas. This question is for Chris. When you announced the first set of PCF deals, you did the video that kind of explained the timing of the cash flows and then the back end on the IRU. Do you mind just kind of quickly refreshing us on that? That's question one. Two, do most of the PCF deals that you have signed subsequently and that you expect to sign going forward, will they look similar? And then lastly, I think more importantly, how do we think about sort of the embedded IRR in those PCF deals that Lumen is earning, and that kind of would help us, I think, sort of split out in the forecast the PCF part of it?
Sure. Okay, I'll try to remember all those. But if we go back to what we said when we and the guidance on how to think about the economics, we really touched on a lot of it today. What we've said is as follows: the cash contribution margins roughly 30%. That's net of the capex. We've said that roughly 90% of the contract value is cash received to fund the builds, and there's obviously a profit in that is what's remaining, and that's what we talked about today, and it's what's helped us get to where we got. And then the revenue, that cash as it comes in, sits in deferred revenue on the balance sheet, and it gets recognized as routes are delivered. So it's not the whole contract. The contract is broken down segment by segment. So as those segments are delivered, Guy's team's been hitting home runs on that. We're on budget, on time. Then that starts to get recognized. And then the 10% that is the operating and maintenance for the network, once that segment is delivered, generally speaking, that's where that comes into play. And that is cash and revenue and EBITDA that's earned in year from there through the remaining 20 years of the contract. Okay? In terms of IRR, it's interesting because technically to do an IRR, you have to have an outflow before you have an inflow. We don't. I mean, one of the beautiful things financially about what PCF is doing for us is it's an investment that was put in the ground 26 years ago. In fact, we were within, our first PCF announcement was within a month of the long time ago CEO being on the front page of Barron's talking about this vision to build this conduit network around the country. And so what happened is that because of advances in fiber optic technology, there was a lot of that capacity that remained. And now it's met its time, and so we're able to monetize it. So from an IRR standpoint, it's infinite. The way we think about it is we price those conduit based off of what the market conditions are. So we're earning our rightful value vis-a-vis what a market price would be or a replacement cost would be, and then the margin and whatnot flows from that. Now, in terms of the last part of your question on what about from here, so first of all, I would say everything that's been signed, the $13 billion, you can fit into the framework I just laid out. What we're not going to do is go do what they did 26 years ago. We are not going to go build a bunch of empty pipes around the country and wait for people to show up. That is not a playbook that works. And that's been proven. That's what almost bankrupted Lumen the first time. So we still have, and we disclose every quarter, a lot of embedded capacity in our network today, and that can continue to be monetized. What's not in the slide that we share every quarter is we still have the opportunity to rip and replace from low count fiber to high count fiber in the conduit that exists. So there is a lot of capacity in the network. If we did build something new, it's going to be like a new route. It's going to be because a customer demands it and we have a contract that backs that up.
Have you recently, I haven't been on recent earnings calls, but have you talked about what the pipeline looks like right now for some of these bigger deals? Are you?
We aren't disclosing pipeline numbers anymore because the reality is when we did that a few years ago, we were wrong. And we've now surpassed that. What we're seeing is more and more demand as the complexity gets bigger and bigger and people are trying to get more and more places with low latency and big pipes. And so that's why our initial estimate of a $12 billion opportunity for Lumen has turned into 13. There is more opportunity out there. There are conversations happening, but we're not going to try to, to frame how big that is. That would just be considered upside. And as we sign those, we'll announce them.
Thank you very much.
Hi, Greg Williams, TD Cowen. Following up on that, is there a resource issue with taking on additional PCF of the $13 billion pipeline? Obviously the capital's there because the hyperscalers pay you up front, but how about your internal resources as you focus now more on digital?
Kai's got loads of time. But why don't you take that?
The short answer is we're not seeing any issues at the moment. We started a brand new team about 18 months ago that we call Custom Networks. So that team was built with the sole purpose of serving these hyperscaler PCF contracts. There's a separate team that was started of program management, where we have a program management team that interfaces each and every hyperscaler. So there's a dedicated account team who are there to serve the customer and make sure the customer gets what they need. And then it's all executed through this custom network team. So you think about The United States split into 3 different regions with a vice president who heads that up with the construction management, the health and safety teams, the governance teams, planning engineering teams, all highly scalable. So as we add more customers, we can easily scale those processes. We built new tools and systems, so it's all underpinned by a system that we call Lumen Vision, partnered with a company called One Vision. That system enables us to do risk-based planning, so we have a 6-month, 9-month view ahead in terms of any bottlenecks, any issues we see with materials, with construction permits, with crew availability, and so on and so forth. So we're able to kind of predict way in advance any kind of resource issue. And then finally, we built an ecosystem. We work very closely with Corning. We have dedicated facilities, so we have certainty of the supply of fiber coming in. We built dedicated facilities with a company called Thermobond in South Dakota, who are producing all of the huts or the ILA facilities for us that are then shipped across the country. We did almost 300 locations last year, which is a lot. And then we've partnered with some of the bigger construction companies across the country as well, right? And so we have, I think, built tremendous scale across the country with multiple vendors, partners, down to a very granular level. So we're in good shape, I would say.
And I'd just like to add to that, Kai. Your team is doing a brilliant job partnering with all those partners you just mentioned, and I think you have a different way of engaging. And one example I would give is Kate mentioned the Luminate culture in the very beginning. That culture goes far beyond our own 4 walls of Lumen into when we work with our partners, and we get exceptional feedback from our partners on how we live different than some other companies they see as well.
Absolutely.
I think we've got time for one last question.
Hi, Ana Goshko from Bank of America. So 2 questions. So first of all, I know Kate mentioned a preference on the inorganic front for services that would be accretive, especially on NAS ports, et cetera. But what is the potential for, kind of old school traditional telco consolidation, especially? Well, especially among, fiber networks where, there could be room for additional synergies. That's the first question.
That was the best nonverbal answer I've ever heard.
I don't know what else to say on it. So if we need it, we will get it. We'll either build it or we'll buy it. But our commitment to driving utilization of our assets is first and foremost, because that's what's going to generate the return to our shareholders. That's frankly long overdue.
Yeah, I would just say that, and I'm actually glad the question was asked. We talked about the division between the past and the future. That's old playbook. New playbook is how we monetize the assets we have and how we create a different layer. So your question, if I think really specifically, is a north-south question, right? The real growth opportunity, the real economic opportunity is the east-west. And so if it fits into that model, to Kate's point, and it furthers that, then yes. But if not, that's not a playbook.
And to your point, there's a line around the block of bankers coming to us with ideas for legacy consolidation plays. And I love that because we're looked at as a strong player now. And we could get acquisitive in that way, but it's only to serve the need of building a digital network services company. If we were to make any such moves, it would be in service of that.
Okay, great. And then, Chris, I know hard to believe just that you've gotten to this point, but I know you have, and all to your credit,
Was that a compliment?
I think it was.
It is a compliment.
We're just going to sit in that for a moment, okay? Hard to come by.
In the past, you've mentioned the potential or a goal of reaching investment grade ratings on your debt, but you also mentioned the fact that you do have some interest rates in your capital structure back from when money was free, kind of a few years back. So it's going to be hard to kind of refi your way into reducing interest expense. As you simplify your capital structure, how much have you thought about going into the ABS market? Because I think virtually a lot of your peers really have been able to go and get sort of investment grade parts of their capital structure. And
We will continue to look at all of those options, and if it makes economic sense, then we'll pursue it. I think the key thing for us at a higher level is the target on our leverage is 3 to 3.5, and I would include ABS as part of that. The one thing that we've got to be cautious about with ABS, and it doesn't mean that it's a no, is that what is ABS, right? You're basically selling EBITDA streams on your assets, which by default means those assets now become less flexible. And if you get underneath the transaction with AT&T, there's a number of different reasons, but a key reason why we sold from the edge of the neighborhood into the neighborhood and kept the pipes is because we need those wire centers, not all of them, but many of them, to further our enterprise ambitions. This is where a lot of those on-ramps are going to sit physically. So again, everything we do is around our ability to expand that. So absolutely would consider it if it's economically beneficial, but would look at those other factors as well and say, does this limit us in terms of our flexibility in using assets to do something bigger? So we're going to be very thoughtful about that.
Okay. All right. Number one, thank you so much for the time and the engagement. Great questions. And this was fun for us to bring our story to you. Thank you for listening.